President Trump signed the big, beautiful bill on the 4th of July, but because of the way the bill was written, many of its tax provisions actually took effect back on January 1st, 2025. And there's a ton of misinformation and confusion flying around the internet about these new rules. So I want to give you a very simple, straightforward breakdown of exactly how these new tax rules already apply to millions of Americans. Specifically, we're going to talk about the no taxes on tips provision you've been hearing about. And this started on January 1st, 2025, but it is set to end on December 31st, 2028. The new law allows for a deduction of up to $25,000 in tips, whether you're single or married. Now, depending on your total income in 2025, you might be looking at a nice tax refund when you file your tax return in 2026. So I am going to cover who gets it, how much this deduction is really worth, and most importantly, the income phase out range you need to watch out for that could reduce or completely eliminate this benefit. So, what exactly is a qualified tip under this new law? And let's turn to the bill itself to page 247, specifically the section under 70201. The law is crystal clear. A qualified tip has to be paid voluntarily without any consequences if the customer decides not to pay it. It also says the payment cannot be negotiated and the amount has to be determined by the payer. Now, think about what that means in the real world. You've been there. You go to a restaurant with a party of 10 and the bill comes with a mandatory 15 or 18% gratuity already tacked on. Under this law, that is not a qualified tip. Employees who receive a share of that mandatory charge will not be able to deduct that portion from their taxes. Now, I have to be honest, I cannot stand it when restaurants do this, and it kills the whole point of a tip, which is supposed to be a reward for service. They do it in Vegas all the time, but now you're seeing it everywhere. And they force customers to tip a certain amount just because it was a large party. From the business's perspective, and I get that it protects their staff's income, but it's a huge catch that means a lot of what servers consider tips would not actually qualify for this tax deduction. Next, to be eligible for this deduction, the tips have to be received in an occupation that customarily and regularly gets tips on or before December 31st, 2024. And this is the government's guardrail to prevent abuse. And they don't want a bunch of industries suddenly relabeling salaries as tips to dodge taxes. And this is specifically for the hospitality and service industries. The Treasury Secretary is required to publish an official list of these qualifying occupations within 90 days of the bill signing on July 4th, which means we should see that list from the IRS by October 1st. In my industry, which is the finance or professional services sector, I do not ask for tips when I give you a 60-minute consultation at firesession.com/consultation, right? It would be completely inappropriate. And this law is designed to stop people in fields like mine and a few others from trying to reclassify their income to get an illegal tax break. It would be shady and it's not something you want to mess with. And this goes with any business owners who pay themselves a W-2 salary under the S corporation tax structure. You cannot just pay yourself tips instead of wages to get that tax break unless you're directly in the industry that is approved by the Treasury Secretary. Now, there was some initial confusion about what kind of tips count, and the original House bill only mentioned cash tips, but the final version of the big, beautiful bill addressed this issue. It now includes cash tips, credit and debit card tips, money from tip sharing pools, and even non-cash gifts. But here's a critical point that everyone needs to understand. This is a tax deduction, not a tax credit, and it is certainly not a complete exemption from all taxes. Your employer is still required to withhold federal income tax from your reported tip throughout the year. The actual savings don't show up in your paycheck. You will get the benefit back when you file your tax return in 2026 for the 2025 tax year. If you receive $20 or more in tips per month, then you're required to report them to your employer. Do most people report their cash tips? I'll let you answer that question on your own. And qualified tips deduction is what's called an above the line deduction, which is good news because it means you can take this deduction and still take the standard deduction. So your standard deduction for 2025 for a single individual is $15,750. For head of household is $23,625. And for married filing jointly is $31,500. And the maximum deduction for qualified tips is $25,000, regardless of your marital status. So if you are under the income limits, you could potentially deduct up to $31,500 in standard deduction and another $25,000 in qualified tips deduction, which could be a total of $56,500. So which means that your first $56,500 could be tax free. And if you're 65 and older, you're qualified to take additional deductions. And I talked about that in this video, and I'll put the link in the description below. And speaking of the income limits, let's go over what they really mean to you, because this is the fine print that matters the most. You qualify for the full $25,000 deduction as long as your adjusted gross income stays under a certain income threshold. But once your income goes over that threshold, the deduction starts shrinking, specifically by $100 for every $1,000 you earn above the limit. The phase-out range is narrower for single filers than it is for couples filing jointly. So how much of the deduction you actually get depends heavily on where your income lands. For single filers and heads of household, that phase-out begins at a modified adjusted gross income of $150,000. Once your income hits $275,000, the tip deduction is completely gone. And that's a phase-out range of $125,000. So let's say your adjusted gross income is, including your tips, is $175,000 as a single individual, and you deduct $150,000, which is the start of the phase-out, and you're $25,000 into that range. So you want to subtract your $150,000 from your $175,000 in income, and that gives you $25,000 into the phase-out range. You take that $25,000 difference and divide it by the total phase-out range of $125,000. That gives you 0.2 or 20%. That means you lose 20% of the maximum $25,000 in qualified tip deduction, and 20% of $25,000 gives you $5,000. So if your $25,000 deduction is reduced by $5,000, your final prorated deduction for the year is going to be $20,000. So if you're single making $175,000 in modified adjusted gross income, the maximum qualified tips that you can deduct are $20,000. That makes sense so far, right? And let me give you another example. Let's say you're a married couple filing your taxes jointly. The numbers are going to be different. The income phase-out starts at a modified adjusted gross income of $300,000, and the deduction is fully gone once you hit $550,000 in modified adjusted gross income. And this is a total phase-out range of $250,000 between $300,000 and $550,000 in income. So let's imagine you and your spouse have a combined modified adjusted gross income of $350,000. You're going to deduct the $300,000, which is the start of the phase-out, and your $50,000 into that range. You're going to need to divide that $50,000 difference by the $250,000 total range, and you get 0.2 or 20%. This is the crucial calculation you need to know, because this formula shows you how far you're into that income phase-out range. So in this example, you're 20% into that income phase-out range, which means you're going to lose 20% of that $25,000 deduction, which is $5,000. Your prorated deduction for the year will be $20,000. Now that you understand the income phase-out range, let's tie this all together with a realistic example. Say you're single and you work at a restaurant making a $40,000 salary plus $5,000 in qualified tips. Your total gross earnings are going to be $45,000 for the year. With the standard deduction, the first $15,750 is not going to be taxed, and the $5,000 in qualified tips is not going to be taxed because you're under the income phase-out range. So your adjusted gross income is going to be $24,250. The first 10% tax rate will kick in for the first $11,925 in adjusted gross income, or that's going to be $1,192.50 in total federal income tax. The next 12% tax rate will kick in for the next $12,325, or that's going to be $1,479. So the total federal income tax you'll owe for 2025 in this scenario is $2,671.50. That $5,000 in qualified tips saves you $600 in total federal income tax because your marginal tax rate is 12%. If you multiply $5,000 by 12%, that's going to give you $600. If your marginal tax rate is 22%, you will save $1,100. And if your marginal tax rate is 24%, then you will save $1,200 in federal income tax. That makes sense so far, right? That's a win. However, you will still pay your state income tax on it, and you will still pay payroll taxes on it. And that's Social Security and Medicare for 7.65%. This deduction does nothing for those. And this is where the common misconception or misunderstanding comes in. You're only getting the federal income tax break and not your state income tax or the payroll tax. This is why the Tax Policy Center found that households making less than about $33,000 a year will not see much of a benefit because their federal income tax bill is already very low or zero. And thanks to the standard deduction, right? And they estimate that's about 40% of households that reported tip income in 2024. And the other 60%, largely middle income households, are the ones who will benefit from it. And with an average tax bill dropping of about $1,800 a year. The more federal income tax you pay, the more this deduction helps you. It is a clever way for Congress to hand out a benefit without giving it to everyone. But you have to run the numbers. You might think you're getting a full tax break, but depending on your income, it might shrink or disappear entirely. And this is where tax planning is so critical. And I've had clients who assumed they would get a full deduction only to be surprised when their total income pushed them into that phase out zone. And they just assumed the news headline meant the money was tax free, period. It's a tax deduction, not a tax credit. You're not going to get a $25,000 tax refund if you made $25,000 in qualified tips. It just means that you're going to be able to save taxes on the total deduction, depending on your current tax rate. And this is especially very focused on right now because I live in the Las Vegas area. And that's why I wanted to do this video. And too many people think this is some kind of a total tax repeal, and it's not. It is a targeted deduction that helps, but it's not automatic. And it's certainly not a free ride. And while you're still wrapping your head around this, feel free to get my free retirement calculator by visiting firestructure.com/resources. And this has been another piece of the video, and I hope you got a lot out of it.